expert for the OECD, pursuant to which he has trained several tax administrators in many countries, including Belgium, Russia, China, Uganda, of course, India, Sri Lanka, Nepal, and Ukraine. Vikram is also the managing editor of Clover International Tax Law blog. The blog is read by 22,000 readers every month. Before I hand it over to Vikram, the importance of Pillar 2 Globe proposals assumes significance because that has been, in general, subjected to lesser debate, and particularly so in the context of India. And when I was, looking at the presentations, and this is the second presentation of Globe 2 that I'm attending, aspects on what is the income inclusion rule, which is fundamental and core to Pillar 2 proposals, the finer differences between effective tax rate and nominal tax rate. And Vikram is also going to touch upon the compatibility challenges and implementation challenges. So with that, Vikram, over to you.
Thank you, Mr. Bhutani, for this introduction. Just give me a second. I will start sharing my slides. So just confirm, Mr. Bhutani, you can see my slides, right?
Yes, Vikram, we can see your slides.
We can see your slides, yeah.
Perfect. So thank you for this nice introduction, and thank you once again, IFA India, Mr. Bhutani, as well as Mr. Kapadia, as well as the entire organization team for inviting me to express my opinion on both Pillar 1 and Pillar 2 proposals. We covered Pillar 1 extensively yesterday, but probably if IFA India gives me another 4 hours to cover the Pillar 1 proposals, I will get into the details of the proposal if IFA India invites me once again in the future for that. The topic of today is Pillar 2 of the digital economy debate. And what are we going to see over the next 1 hour, 15 minutes? And I will try to be on time today as compared to yesterday where I was a bit late. So we will just look into the background of the proposal and we'll do a case study. After that, we will get into some issues which deal with how do you go about determining effective tax rates and how do you apply this subject to tax rule and determination of nominal tax rates under the subject to tax rule. Then we will discuss a few compatibility issues of the proposal with tax treaties and European tax law. We'll spend a few minutes on implementation, and finally, I will conclude the presentation with some remarks. So let me just start with the background. So why has Pillar 2 actually come into existence? Now, from a policy perspective, a question that has been raised pursuant to the BEPS project was how do you combat profit shifting and tax competition among countries? Now, why is this question relevant? Why do you think the question is relevant? So if you look at the international tax system right now, as I was speaking to you about it yesterday, corporate tax is levied in the country where an enterprise has its production factors. So essentially, income is allocated to the country where where an enterprise has its people, where the people functions are present. The advantage, or let's say the disadvantage of allocating taxing rights to the country where people are actually present, either from a transfer pricing or a profit allocation perspective, or from a tax treaty standpoint, or national law perspective, the advantage, or let me say the disadvantage, is that these production factors are mobile. So people are mobile. Even capital, so people and capital, they, as well as intangible assets, they are mobile in nature. So because these assets, people, intangible assets, or capital, these kind of items are mobile in nature, they can be easily shifted from one country to another country. So essentially what multinationals can still do in the post-BEPS world is that they can engage in profit shifting. And why? How can they do that? Is by having the right people in the right locations doing the right job. So multinationals can still engage in profit shifting. So for example, if there's a US multinational which has operations in the US where they are paying a corporate income tax of, before it was 35, then post-Trump it was around 20, in the 20s, 21% if I recall correctly. If they want to just lower their tax rate, they can just move all the production activities or the intellectual property related activities to a lower tax country. They can move to the Bahamas where the tax rate is zero, or they can move to Ireland where the tax rate is 12.5, or they can move to other smaller jurisdictions. So multinationals can still engage in profit shifting. At the same time, by engaging in profit shifting, you can give now rise to genuine BEPS concerns, not fake BEPS concerns, because the fake BEPS concerns were fixed by the BEPS action plan. So now genuine profit shifting concerns could arise. Now, at the same time, what have we been witnessing is that countries are competing intensively. So tax competition is on the rise among countries, and countries are competing to attract these mobile factors. So countries are competing to attract people. They are competing to attract capital. They are competing to attract intangibles. And they can compete by firstly offering tax incentives. If you just know, in the BEPS Action 5 report, the OECD had proposed a Nexus compliant IP box regime, which exempts income from IP related activities. And at the same time, many countries have R&D incentives, and these incentives have just like increased since 2015. A lot of countries have started introducing tax incentives, which are substance-based tax incentives. They're not fake tax incentives anymore. They're substance-based tax incentives. At the same time, there's been this downward reduction of corporate taxes across jurisdictions. And this is where I would just like to show you what the CIT rates were, corporate income tax rates were, before COVID-19. So if you just have a look at this graph here from the year 2000 to the year 2018, there's been a gradual decline in corporate tax rates as well as corporate tax revenues. And if you see it in the other slide that we have here, the other image is the distribution of combined statutory CIT rates. You compare what the CIT rates were in the year 2000. So if I just see on the left-hand side of the screen in the year 2000s, if you look at the blue line, you had many countries with tax rates over 30%. And then in 2020, if you look at the second little gray line in the box there, you see how many countries have corporate tax rates above 30%. So the number of countries who've had corporate tax rates above 30% between 2000 and 2020 has come down quite significantly. And if you look at the other end of the chart, you will see that countries have somehow increased their corporate tax rates, or the number of countries which have corporate tax rates of below or equal to 20% have increased. And this is actually, these statistics have been taken from a recent report issued by the OECD in September from the Tax Policy Reform Report, which clearly shows that CIT rates are actually going down. So what is the globe trying to achieve? While the policy rationale of this proposal is not absolutely clear, but one thing is for sure is that this proposal is trying to combat profit shifting and tax competition. So it wants to reduce the incentives of multinationals to allocate profits to low tax countries. And at the same time, it wants to somehow establish a cap for tax competition. Because the fear is that countries are going to compete for a race to the bottom. So there's going to be a race to the bottom phenomena, which means that the corporate tax rates are just going to go down. So the policy objective behind the GLOBE proposal seems to be combating profit shifting and tax competition. And this is why the GLOBE rules have been introduced. Now, just to do a very quick recap with respect to these rules, Firstly, the group rules have something known as a subjective tax rule. They have in the Pillar 2 rules have a subjective tax rule, which is followed by the globe rules, and the globe rules actually include something known as an income inclusion rule, and this income inclusion rule is backed up by a switchover rule. And finally, there is an undertax payment rule, which does not apply, which not apply initially, but if the income inclusion rule does not apply, then countries can go ahead and apply the undertax payment rule. Now, you may ask me the question, why did Vikram start by presenting the subject to tax rule? And the reason is very simple, because the rule order, when you're applying this entire Pillar 2 proposals, is that firstly, you would apply the subject to tax rule. That's the rule that applies first, because as you know, you need to coordinate how the rules are going to be applicable. So the subject to tax rule applies first, and this is actually in the interest of developing countries, which I will allude to a bit in the future. Then you would apply the income inclusion rule and the switchover rule, but the switchover rule applies in very limited situations, as I will explain it to you. And finally, if the income inclusion rule does not apply, you would go ahead and you would apply the undertax payment rules. Now let's just do a case study here to explain how these rules are going to work and the various concepts that have been used in this rule. So let me just explain to you this structure of this multinational enterprise before I get a bit into the numbers. So in this case, we have uh, ARCO, which is the ultimate parent entity of the group. Now, ARCO has a branch in state P, and this branch is established in a country where the statutory income tax rate or corporate income tax rate is 7.5%. In state R, where ARCO is, the corporate income tax is 35%. Now, ARCO has a subsidiary in state T, and this state T subsidiary is owning the IP of the group, and actually it licenses out the IP to ESCO, which is in state S, and in return, state S or company S pays royalties to this company, or which is in state T. The corporate income tax rate in state T is 10%, and the corporate income tax rate in state S is 30%. A few more facts here before I get into the numbers is that the tax treaty between country T and country S is based on the OECD model. And as we all know, according to the OECD model, royalty income is taxed exclusively in the state of residence of the recipient company. And here, if we assume that if a royalty is being paid by ESCO, even if there's a withholding tax under the national law of state S, as per the treaties, the taxing right on the royalty income is allocated to state T, and hence state S cannot tax that income. With respect to the relations between ARCO and the PE, we also assume that there's a tax treaty which contains the exemption method, Article 23A. And this, according to this exemption method, all the profits which are derived by the branch, which are subject to tax or which are taxable in state P, are exempt in state R because of the tax treaty in place between state R and state P. So now let me just get into a bit into the financial information, because I need to explain to you some concepts such as effective tax rate, adjusted nominal tax rate, so on and so forth. So in this example, we assume that the profits which the permanent establishment is making is around $100. So the income of the P is 250, and the expenses incurred at the level of the permanent establishment is 150, out of which 30 is allocable to payroll costs and 20 to tangible components, for example, depreciation. The profit which is booked in the PE is $100, and the statutory CIT rate is 7.5%. So the tax that has been paid to the local tax administration in state P is 7.5. So the effective tax rate in state P is 7.5%. So what is the formula to calculate the effective tax rate? It's the actual tax paid, which is 7.5 divided by PBT, the profit before tax, as per the financial accounts, which is 100. So the effective tax rate in the PE location is 7.5%. the profits of the P. Moving to what's happening in country S is that we see that the income in country S of ESCO is 1,500. The expenses are 1,000, which includes the arm's length royalty payment of $100 to TICO. And the PBT, as per the financial accounts, is $500. The statutory CIT rate is 30%. And the tax paid in country S, for corporate income tax paid in country S, is $150. So the effective tax rate in country S is 30%. How did we get that? Once again, it's the tax is paid $150 divided by the PBT figure, which is $500. So we get an effective tax rate of 30% in country S. In country T, on the other hand, we have an income which is of 100. That is the royalty income which TICO has received from ESCO. The expenses incurred in state T, let's just assume it's $10, which is five towards payroll costs and 5 towards tangible components. That means depreciation expenses. The PBT as per financial account is 90. In this country, it's state T, let's assume that the statutory CIT rate is 10%. But this country has a territorial regime. Now, what does that mean? A territorial regime is that all income which has been, which is foreign source, is exempt from taxation. So effectively, the taxes that have been paid to the local tax administration are zero. And here, the effective tax rate is once again zero. How did we come to a 0% effective tax rate? Is 0 divided by 90, which is equal to 0. It's as simple. So these are the facts these are the facts of this entire group before we get into the details of how we go about applying the rules. So just keep these facts in mind, especially the effective tax rates. Now let's assume that all countries here have implemented the Pillar 2 proposal. What does that mean? Is that ARCO, being the ultimate parent entity of the multinational group, is subject to an income inclusion rule which has been introduced by country R. The tax treaty between ARCO and the permanent establishment now contains the switchover rule. Now, the switchover rule would essentially say that you move from an exemption to somehow the profits are the switchover rule would actually allow ARCO to apply the income inclusion rule to branches essentially, which could not be applicable because there was a tax treaty exemption mechanism in place. But now the DTA contains a tax treaty contains a switchover rule which would permit ARCO to tax the profits of the permanent establishment. Interestingly, now the treaty between TICO and ESCO, even though it's based on the OECD model, it contains the subject to tax rule, which is a treaty-based rule. So here, if you look into the rule application, like I had mentioned to you at the start, the subject to tax rule would apply first. But before I just get into one more point, before I get into the solution of this case, we just assume that the minimum effective tax rate for the application of the income inclusion rule and the undertax payment rule and the switchover rule is around 12.5%. So that is the minimum tax rate that has been agreed. And the minimum tax rate for the subject to tax rule is 7.5%. So that's the adjusted nominal rate. And the share of payroll and tangible asset carve out is pegged at 10%. So coming back to the solution of this case, as a start, like I mentioned to you, the subject to tax rule would apply first. Now the subject to tax rule applies on a nominal basis. Now what does that mean? So what does a nominal rate actually mean is very simple, is that you need to look into the laws of the country. Here state S will need to look into the laws of country T, and as per the laws it will see, okay, the statutory income tax rate is 10%, but we know you're a territorial regime, and because you're a territorial regime, your adjusted nominal rate would be 0%. And as simple as that. And this information can be available in the public domain. So, like for example, without naming the country, if the corporate income tax rate in a country is 15%, but 80% of that income is exempt of offshore income is exempt from taxes in that country, so the adjusted nominal rate in that country would be 3%. So uh, how do you go about calculating these adjusted nominal rates is something which I'll speak about later. So here, the objective here is to give country S the taxing rights over the difference between the top-up rate under the subject to tax rule, which is 7.5%, and the adjusted nominal rate, which is 0%. So because the adjusted nominal rate here is 0% and the minimal tax for the application of the subject to tax rule is 7.5%, effectively the top-up tax under the subject to tax rule becomes 7.5%. On the other hand, for example, if the adjusted nominal rate was 3% and the top-up and the minimum tax under the subject to tax rule is 7.5, the difference would only be 7.5 minus 3, which will be 4.5. But here we say that the adjusted nominal rate is 0%. So the top-up tax in state S would be 7.5% under the subject to tax rule. So effectively, on this $100 of royalty income that has been paid out, state S is entitled to tax $7.5 under the subject to tax rule. So that was with respect to the subject to tax rule. And then moving on, we have now just on the relations between ARCO and the permanent establishment, the branch there. Like I told you, the effective tax rate of the branch is 7.5%. And the minimum tax rate that has been agreed under the income inclusion rule for the purpose of applying Pillar 2 is Pillar 2 rules for income inclusion rule and UTPR rules is 12.5%. So the top-up tax, so effectively the tax that has been paid in the branch is 7.5%. That's the effective tax rate. So the top-up tax, which is the difference between the actual tax ETR and the minimum rate, would be 5%, 12.5 minus 7.5. And the globe tax base on which these taxes will have to be paid is 100, which is the profits of the branch. Now, because there is like a substance carve out that is being contemplated in this entire proposal, a substance carve out is being contemplated as a return on tangible assets. So in our example, a return on tangible assets and payroll expenses would be 10% of the local cost, which would be 10% of 50, which will be 5. So the adjusted globe tax base is around 95 in the state of the permanent establishment or state of the branch, is the tax base. So what do we have to do? We need to pay taxes under the income inclusion rule. In other words, because country R has introduced an income inclusion rule in its national law, the profits of the permanent establishment will now be taxed in country R. And they will be taxed on the difference between the actual tax paid, 7.5% on a profit of 100, and what you're supposed to pay under the globe rules. So the globe tax base, or the adjusted globe tax base, is 95 in our example. So the taxes that will have to be paid under the income inclusion rule is 95 into 5%, which is the top-up rate. Top-up rate is around $4.75. So that's on the relations between the P and ARCO. With respect to the relations between country R and country T, we see that the effective tax rate in country T, because it was a territorial regime, was 0. So the initial ETR was 0. But because there were some taxes that have been imposed under the subject to tax rule, that was $7.5, which was paid into country S. So these taxes that have been paid, withholding tax is always a tax for the income recipient. So this tax pushed up in the sense that the taxes paid by country T as a result of by company T as a result of the subject to tax rule is $7.5, and the taxable base in country R was 90, So the effective tax rate of the company in country T was 8.33%. Now this 8.33% is actually lower than the 12.5 minimum rate under the GLOBE rules. So a top-up tax will be required to be paid under the income inclusion rule, which is the difference between 12.5 and 8.33, which is around 4.17%. Normally the GLOBE tax base is 90, but because of a substance carve out, because the substance carve out here reduces your GLOBE tax base. So in our example, a return on payroll and tangible assets would give you the conclusion a 10% return on payroll and tangible assets would be equal to 1. So the adjusted GLOBE tax base is around 89. And the tax that will have to be paid under the income inclusion rule here would be 89 into the top up rate, which is 4.17, which is equal to $3.71. So by applying the income inclusion rule, the taxes that have to be paid in country R, because country R will introduce the income inclusion rule, because that's the country where you have the ultimate parent entity of the multinational, would be the sum total of the taxes in state T as well as in state P, which would give you in total $8.46 under the income inclusion rule. So just to summarize, in this case, country S gets taxing rights under the subject to tax rule of $7.5. Country R would get in total $8.46 as taxes. So when just one final point, when ARCO would apply, the question is, does the income inclusion rule apply to the profits of ESCO? The answer is no. Why? Because in ESCO, the effective tax rate was 30%, and this effective tax rate was much higher than the minimum rate that has been decided, which was 12.5%. So in jurisdictions where the minimum tax rate is less, where the effective tax rate is less than 12.5%, those jurisdictions would be somehow caught by the income inclusion rule. So what is the income inclusion rule? So the income inclusion rule is like a CFC rule, controlled foreign company rule, or let's say it's a super CFC rule, because CFC rules would apply before the income inclusion rule. Now what happens? Now let's just assume that country R does not really introduce the income inclusion rule for whatever reason, because it's not a minimum standard and they just don't want to introduce an income inclusion rule. Then in that kind of situation, the under tax payment rule will kick in. Now if you assume here that country S has introduced a under tax payment rule in its national law, then in that kind of situation, the taxes which would have been paid, the taxes, or let's say the GLOBE tax base, which was allocated to country T, in the sense that the taxes which were required to be paid for the country T income in country R will now be allocated to country S, because country S has the under tax payment rule introduced in its national law. So if country R does not tax the income inclusion rule, then the taxes which relate to country T would be reallocated back to ESCO, and ESCO would be responsible for paying the taxes under the UTPR, under tax payment rule. Now the profits of the PE will not be subject to tax in country S here, in state S. Why? Because there's no connection between state S and the PE branch. So nothing happens in that relation. So this is how the pillar 1, pillar 2 rules are supposed to work. You would really need to look into the financial statements of each and every entity in each and every jurisdiction of in which the multinational actually operates. Now, coming to the scope of these rules.
Vikram, can I ask a short question?
Yes, please. Yes.
Is there any reason in your example that you have kept the subject to tax rate at lower than the higher rate, 12.5 and 7.5? Is it how it is expected to pan out?
Yes, it's expected to plan out like this, because this rules apply on a payment basis, and if the pay and the reason why they are in is actually because they apply on a payment basis, and you don't really have to wait till the end of the year for the calculation of the rules. But actually, I'm going to cover this point a bit in the future, why there is a difference in the rates here, and the way the proposal is going to plan out. So maybe we take this question a bit
Okay, you
later,
can
if you don't
continue.
mind.
You can continue. Yeah.
Okay, so in relation to, but that's the idea right now, that the subject to tax rule, because it applies to payments, and there can be thousands of payments from a multinational enterprise. The objective is to just have it, and it's on a gross basis. It's not on a net basis. So there's no net basis. It's a pure gross basis rule, which is planning to be introduced. So that's why they wanted to have a lower rate. But I'll come back to you at this point a bit later. So in terms of the scope of this proposal, the income inclusion rule and the under-tax payment rule, including the switchover rule, would apply to M&E groups which have a gross revenue of more than 750 million euros. So this is something similar to the Pillar 1 proposal with respect to the scope of the M&Es that are being covered. Some entities have been excluded for various policy reasons: investment funds, pension funds, governmental organizations, NGOs, international organizations. They have been carved out from the scope of this proposal. But compared to Pillar 1, the scope for the income inclusion rule and the under-tax payment rule is much broader than what you see in a Pillar 1, which applies in ADS and a CFB context. With respect to subject to tax rule, this is very interesting here. For the subject to tax rule, this rule applies to covered payments between connected persons. So where any kind of payment which is a deductible payment except dividends, so it can be interest, it can be royalties, it can be fees for technical services, it can be rent, it can be brokerage fees, so on and so forth, will be a covered payment, and they have to be applicable between associated enterprises or connected persons. This rule, there are some exclusions to this rule too. They will not apply to excluded entities, the same entities which are mentioned in the IIR, such as investment funds, pension funds, and so on. With respect to the revenue threshold, so the materiality threshold also needs to be met in this rule, but this need not be similar to the income inclusion rule, because for the income inclusion rule and the UTPR, there's a revenue threshold in the sense that it will apply to M&Es which have more than 750 million of revenues. But the number that has been put across in the report for this application of the subject to tax rule is payments which are being made to an entity if they exceed more than, I think, 750,000 euros. So from a paying state's perspective, the threshold is quite low, and it can be even lower because there's no decision that has been taken. So if developing countries actively participate in this proposal, they can actually get down these amounts and say, okay, the subject to tax rule will apply to payments which cross a threshold of let's say $500,000 or something like that, more than 2 crore rupees, for example. And it would be applied when a payment is made to low nominal rate countries. Low nominal rate countries are countries with which have a statutory income tax rate that could be whatever, it could be 10%, 15%, but because of some kind of special regimes or special provisions in their national law, if they are exempting foreign source income, then the effective tax, the nominal tax rates would drop down quite considerably. In terms of the revenue effects of the Pillar 2 proposal, if you look at the Pillar 2 proposal, actually the estimates here is that if adopted globally, they will add more in CIT, global CIT revenues as compared to Pillar 1, and the amounts could vary anywhere between 42 to 70 billion dollars of tax revenues for governments, depending on how these rules are actually adopted in the national laws. So one of the biggest issues in this proposal is effective tax rates, because how do you go about determining effective tax rates? And there are many issues, but in the interest of time, I've picked up only some selected issues. One is the definition of effective tax rate is how do you go, what is in the numerator, what is in the denominator, because as we've seen in the case study before, the effective tax rate is, the formula is taxes paid by PBT, profit before tax. So here the effective tax rate formula is covered taxes by globe income. There are some issues with this proposal with respect to um, with respect to which jurisdiction will you allocate withholding taxes or CFC taxes. But in general, withholding taxes, just to keep this logic in mind, withholding taxes are pushed up, CFC taxes are pushed down, and I will explain this with a few examples. Then how do you deal with volatility? Because here what you're doing is you're looking into the financial statements. You're not really looking into tax returns of each and every local entity in each and every jurisdiction. You're looking into the financial statements. So pillar one actually looks into, so to determine the pillar one tax base, you look into the consolidated financial statements. Here also you look into the consolidated or the financial standard that has been used to prepare the consolidated financial statements. So if you have a US M&E, you look into US GAAP, and you will see, according to US GAAP, how this multinational has done consolidation for all its subsidiaries all over the world. And you would typically apply whatever information that you use under the US GAAP for each and every entity when it wants to do a consolidation exercise. So here also with globe rules, you're looking into the financial statements of the entities in each and every jurisdiction. You're not really looking into the tax rules as such. And so because you're looking into the financial statements and not tax rules, there are some issues that could arise with respect to deferred tax calculations, some timing differences, permanent differences. But to reduce this volatility with respect to these differences, because of the fact that you're using financial statements, there are some loss carryover and excess tax rules that are being developed, as well as some rules to deal with substance carve-outs. But the substance carve-out is something which I've already explained to you. It reduces your globe tax base. And finally, the biggest issue is jurisdictional blending versus a global blending issue, because jurisdictional blending is what the Pillar 2 proposal has proposed, whereas the US GILTI has a global blending, and I'll explain these concepts to you. So let's start with the definition of effective tax rate, because effective tax rate is, the formula is simple. It's covered taxes by adjusted globe income, covered taxes by PBT. So when I say adjusted globe income, I mean it's PBT, globe PBT. Actually, so what kind of taxes are covered? Now, in generally, all corporate income taxes are covered in the numerator. So all the taxes which a multinational pays as corporate income tax, they would be covered. But in some countries, because here the OECD has done an extensive analysis and seen in many countries, in general, in many countries, when a company pays taxes, it's called corporate income tax. But the moment at which taxes are being paid in some countries, it could be different. For in Estonia, or in Estonia, I think it's Estonia, where you pay taxes or company pays taxes not when it makes profits, but it pays corporate income tax when it distributes profits. I think it's Estonia, one of those countries there in that region. So, a lot of commentary has been provided of what constitutes covered taxes. But in general, corporate income tax is what we are talking about here. Excluded taxes, very interesting. What is excluded? So all indirect taxes, VAT, GST, custom duty, all this is excluded taxes. DSTs are excluded taxes. So DSTs are not covered by the scope of this proposal. So DSTs are out. So they cannot go into the numerator. Stamp duties and transfer taxes, but that's obvious, and property taxes that are being paid. So they're really looking into corporate income taxes, the tax that has been paid. So just to repeat, the formula is covered taxes by adjusted globe income, the tax base, or we need to determine the PBT number for the application of the tool. So the tax base, like I mentioned to you, will be based on the financial statements. And you will need to look into the financial statements of each and every jurisdiction, which mean the financial statements which have been used for consolidation purposes by the ultimate parent entity of the group. You will still need to do a jurisdictional analysis and look into the financial statements of each and every entity in each and every jurisdiction. And you would need to make some slight adjustments, like in the Pillar 1 rules, also some slight adjustments were being proposed. Here also some slight adjustments are being proposed. So you have your P&L of every entity, the P&L. So on the income side, you reduce non-recurring income, for example, dividend income. That's not your it could be your main source of income, but dividend income is somehow excluded. On the expense side, also you make some adjustments. For example, you take into consideration some amounts which are stock-based compensation expenses, as long as they are considered to be tax deductible for the purposes of the local jurisdiction. So you have the P&L, so you have the income, you have the expense side. You have to make some adjustments to the income and the expense side to come up with your PBT number, because the formula is taxes covered taxes by PBT to determine your effective tax rate. So some adjustments are required there. So that was the first issue. The second is with respect to assignment of income and taxes. I'll just discuss a few selected cases. So the main rule is that you should allocate taxes, because we need to know, because taxes, corporate income tax may need not be paid only in the jurisdiction where the company is a tax resident. It can be paid in other countries, like for example in the form of a CFC tax, or in the form of withholding taxes. Typically, withholding taxes, just keep this logic in mind. The withholding taxes are pushed up, and CFC taxes, they are pushed down. Let me explain this to you of how do you go about assigning a withholding tax. So here in this example, we see ARCO. ARCO has a subsidiary which is TICO, and TICO, let's say it owns IP, licenses out the IP to ESCO, and receives a royalty income of $100. Let's just assume that the effective tax rate in country country T is 0%, and let's just assume that ESCO makes a payment of royalty payment of $100 to TICO, and the domestic withholding tax is 30%. And let's just assume, for the purposes of simplicity in our example, there's no tax treaty between state S and state T. So the tax that has been paid in state S, which is a withholding tax, is $30 on this royalty payment. So now, if you think about it from the application of the income inclusion rule from the perspective of ARCO, because the income inclusion rule will be applicable to ARCO, the question that arises is the withholding tax that has been paid in country S, to whom should it be allocated? To which country should it be allocated with respect to determining the effective tax rate? Should it be allocated to country T, or it should be allocated to country S? Now, according to the GLOBE rules, this withholding tax will be allocated to country T, because indeed, when state T, TICO is the recipient of the income, and TICO as a recipient of income has paid some kind of withholding tax in country S. So for the purposes of the GLOBE rules, the tax that has been paid under withholding taxes is allocated to country S. Is allocated to country T because it is pushed up. So withholding tax in this from state S to state T, it has been pushed up. So effectively, the effective tax rate in state R for the purposes of the effective tax rate in state T for the purposes of the income inclusion rule is $30 by 89 of income, which is the income of TICO, which would give you around 33.33%. As the effective tax rate of TICO is above the minimum rate, let's just assume it's 12.5%, the income inclusion rule is not applicable for the profits derived by TICO because of the substantial withholding tax that TICO was exposed in state S. So the withholding tax has been pushed up at the level of TICO, so it goes and sits in the numerator of TICO with respect to covered taxes. On the other hand, for CFC taxes, the logic is different. The CFC tax is pushed down. Once again, let's just assume here country R has the income inclusion rule. Country P has a CFC rule. And here we have PICO, which has a CFC rule, and PICO owns ESCO, and let's just assume ESCO receives passive income from offshore operations. So in this example, just to give you more facts, ESCO receives passive income only from offshore entities. For example, it's interest and royalty payments. The PBT of ESCO is let's say $100. The tax paid is 100. Tax paid is 0 because it's a territorial regime. So the effective tax rate in country S is 0%. So this is what has happened so far. But there's a CFC rule now. In country P, there is a CFC rule. So many countries have CFC rule. I don't need to explain that. Many countries in many common law, civil law countries have CFC rules. So let's assume that the CFC rule applies now for the income that has been derived by ESCO. So in this case, the income under the CFC would be under the CFC rules for PICO would be 100. And if you assume the corporate income tax rate in country P is 30%, the CFC tax that has been paid in country P is around $30. So now from the perspective of applying the income inclusion rule, the question once again arises is, to whom shall this CFC tax be allocated? Is it country P or is it country S? Now the globe rules allocate CFC rules to state S, to country S, because the CFC tax is pushed down, because the CFC tax is actually a tax on the corporate profits derived by ESCO. So even though the effective tax rate in ESCO is 0%, now because the profits of ESCO have been subject to a CFC tax in state P, for the purposes of applying the income inclusion rule, the effective tax rate calculation takes into consideration the CFC tax for country S. And effectively, because 30 is pushed down to ESCO, in the numerator is going to be 30, in the denominator is going to be 100. So the effective tax rate for country S here, for the purposes of income inclusion rule, is 30%. And as the effective tax rate is above the minimum rate, the income inclusion rule is not applicable for ESCO. So these withholding taxes and CFC taxes have to be taken into consideration when you're going about applying the income inclusion rule. So just to repeat, the effective tax rate calculations are only required for income inclusion rule, UTPR rule, and the switch over rule. So that was the second issue, is about assignment of taxes. Third issue is, how do you go about determining the tax base? Like I mentioned to you, a substance-based carve-out is being considered, and I've explained this at the start of my presentation in the example, where substance-based carve-out. So whatever your PBT is, so you have let's say you're in country A. In country A, you have the ultimate parent entity is in the US. So a US parent has a subsidiary, let's say in India. And in India, you have a subsidiary and you have the income of the subsidiary, the expenses of the subsidiary, you have your PBT. Now, whatever the PBT you arrive at for the purposes of the globe rule, you can make an additional adjustment to reduce your PBT, and you can carve out some return which is allocable to physical activities that take place in the jurisdiction, in the sense that you can reduce from your PBT a substance-based a return allocable to substance-based carve-out. So this return will be calculated as a percentage of your payroll expenses plus depreciation expenses, and that will determine your carve-out for a jurisdiction. For example, it can be 10% of your of the total sum of the payroll component and the tangible asset component. The payroll component, it includes the salary cost. So what does it mean, payroll component? It's the salary cost of all the eligible employees. What is the tangible asset component? It's actually very simple. It's depreciation, which is allocable to to plant and equipment. It's also, when you're dealing with natural resources, certain deemed return on the value of natural resources, and deemed depreciation of land if you own some land in the books of the business. and as well as a certain percentage of, in the case you're not owning your land, but you're renting a property, you get some kind, you can claim a deduction also as a certain percentage of your return or your rental expense, to put it very simple. So you can carve out from your PBT that you arrive additional amounts, in the sense you can reduce from this a return which is allocable to certain physical elements present in the jurisdiction, such as payroll, like local people working there, as well as assets belonging to that entity. These rules also provide for some loss carry forward. So similar to Pillar 1, which we've seen, losses are dealt with in the Pillar 1 proposal. Losses are actually dealt with in the Pillar 2 proposal also. So if you have in 1 year, let's say US parent, Indian subsidiary, actually, US is not the best example because the US has guilty. So if you say German parent, Indian entity, if you have the German parent and the Indian entity, and you see in India there's this loss-making entity, and so what can happen in this situation is that these losses which you're making in India in year 1, they can be carried forward and they can be set off against a profitable base that may you have in that may exist in India in the future, and these these losses can be carried forward indefinitely. At the same time, there are some kind of provisions for pre-regime losses. So like we've seen in Pillar 1 yesterday, Pillar 1 also deals with pre-regime losses, as well as it deals with within the regime losses. So here also in Pillar 2, there are some pre-regime losses, and within the regime losses, some rules, specific rules for that. There could also be situations where there are some excess taxes that are available as credits. So how do excess taxes actually arise? Now, excess taxes can arise in a jurisdiction when you actually pay your income tax, which is much above the rate, the rate which has been set globally. So for example, once again, if you have German parent, Indian subsidiary, and we see that in India, on an income of 100, the Indian entity pays corporate income tax of 30%, for example. So the effective tax rate in India is 30, so the tax rate is 30. Let's say the minimum rate, which is decided under the globe rules, is 12.5%. So the difference between 30 and 12.5, which is 17.5, 17.5, can be used as an excess tax. So in the future in India, if there's a, for example, in the year 2, let's just assume that this entity, in the Indian entity, is availing of ATC benefits. I don't know if that still exists, but I just came across that. Some kind of tax incentive which is being availed in India, and it's not paying any taxes. So suddenly, if there is a tax liability that has to be that is applicable at the level of for the purposes of determining a jurisdictional ETRs, you can take a credit of the 17.5 tax, the excess tax that you had in year 1. So there are two kinds of excess taxes. One is a local tax carry forward, the local excess tax, which I just mentioned to you. I just saw a message popping up. Are indirect taxes covered by this proposal? The answer is no. Indirect taxes are not covered in the ETR computation. So when you're talking about, I'm talking about excess taxes, not excise taxes. So excess taxes can be available locally, which can be carried forward. And at the level of the parent also, there are some income inclusion rule tax credits, which can be used, and they can be used for set off among different jurisdictions, whereas the local excess taxes can be set off within the jurisdiction itself. So some rules are there. They are quite complicated. If I have to get into the details of the rules, I'll take another 1 hour to explain them. But that's how there are some rules to provide for that. Interestingly, these rules apply on a jurisdictional to jurisdictional basis. Now, what does that mean? So these rules apply a jurisdictional blending approach, which essentially means that you need to aggregate the amounts of on a jurisdiction by jurisdiction basis. And in case the tax in a given jurisdiction is effectively taxed below the minimum rate, then you would need to make a top-up tax. Now, let me give you an example of what I mean by jurisdictional, uh, um, approach. In this case, we assume that we have a German parent, which is applicable to the income inclusion rule in Germany. And this parent has two subsidiaries, two in Hungary, and at the same time, it has two in India. Now, in Hungary, as we all know, the corporate income tax rate there is around 9%. So it's a very low corporate tax country. So the corporate tax rate is low there. So in Hungary, let's assume that there is the CIT of 9% and Subco 1 has earned 400 income, which is taxed at ordinary rates at 9%. And Subco 2 has earned $200 of income, which is taxed at, which is actually enjoying the benefits of a IP box. And because it's enjoying a benefit of an IP box, let's just assume it's the corporate income tax rate is 0, effective tax rate is 0 for Subco 2. For Subco 3 and for Subco 4, which are based in India, let's assume that Subco 3 earns income of $500, which is taxed at a normal corporate income tax rate in India. Let's assume for simplicity is 30%. And Subco 4 earns $100 and enjoys a tax holiday, and it's taxed at 0%. So in this kind of situation, if you have to do a jurisdiction by jurisdictional analysis, you will see that in Hungary, so let's start by Hungary. In Hungary, you see that the effective tax rate paid by Subco 1 is around 9%, and the effective tax rate paid by Subco 2 is 0%. But what typically happens in a jurisdictional blending scenario is all the income of the Hungarian subsidiaries are added up. So the income is 600. The taxes that have been paid locally to the Hungarian government amount to $36. So the actual effective tax rate based on this calculation of 36 by 600 gives you, I think, around 6% effective tax rate. So because in Hungary, the effective tax rate is below 12.5%, let's assuming the minimum rate that has been agreed is 12.5%, then there would be a top-up tax that will have to be paid in Germany. And the top-up tax would be the difference between 12.5 and 6, which will be 6.5% on the income of 600. So a top-up tax will be required to be paid in Hungary. On the other hand, if you take India as an example, in India, you had Subco 3, which is paying effective tax rates. Effective tax rate is 30%. On an income of 500 and Subco 4 is enjoying a tax incentive, so no taxes are being paid. But on a jurisdictional basis, the total income in India is 600 and the tax paid is 150, which gives India an effective tax rate of 25%. And because the tax rate in effective tax rate in India is 25%, and this is much higher than what has been agreed internationally, there would be no top-up tax that will be required to be paid in Germany under the income inclusion rule. Because in India, the effective tax rate is 25%. And in fact, the difference between 25% and 12.5 would be an excess tax, which would be eligible for carry forward for future years in India. Now, I just want to make a comparison here between the jurisdictional blending approach with the global blending approach. Under a global blending approach, what typically happens is that all the income of all the offshore subsidiaries, we have one German parent here with all offshore subsidiaries. So the income of all the subsidiaries is added together, and you see the income is 1200. The taxes paid by all the offshore subsidiaries, the covered taxes are added together, and you see the covered taxes are 186. And then you would come up to your effective tax rate for your offshore operations, which would be 186 divided by 1200, which would give you an effective tax rate of 15.5%. So if these rules were applicable on a global blending basis, then the income inclusion rule would not apply in Germany. But because these rules are applicable on a jurisdiction by jurisdictional basis, the income that was low taxed in Hungary would be picked up under the income inclusion rule in Germany. So why are we discussing the global blending approach is very simple, is because the US actually follows a global blending approach. So let's just assume in our example now that we have Arco, which is in the United Kingdom, and United Kingdom, UK has introduced an income inclusion rule. It has a subsidiary in the US, and the US subsidiary owns, let's say, all the subsidiaries of the group in Latin America, in South America. So the US here would apply the GILTI based on a global blending approach, whereas the UK, because it's a part of the inclusive framework, will apply the income inclusion rule based on a jurisdictional blending basis. So there's a conflict now of how would you go about applying these rules? Uh, um, and to answer this question, it would be quite difficult. And I think this is one of the biggest challenges of this proposal is how do you solve the conflict between global blending, which is there in the US, and jurisdictional blending, which is there in the UK. So there's no answer which is available right now. So we still have to wait and watch with respect to what's going to happen. And I think there's a deadlock because that's why the proposal speaks about grandfathering. This concept of grandfathering the US GILTI rules is being discussed as a result of this example. Because the US is not going to switch to jurisdictional blending. I don't think US will change their rules, their GILTI rules. So that's the big issue right now, is how do you accommodate the US GILTI rules in these kind of structures? One answer is very simple. If the US GILTI rules would apply, then UK would not apply the income inclusion rule if you have to accommodate the US GILTI rules into the mix. Then, of course, as we've seen, calculating these ETRs on a jurisdiction by jurisdictional basis can get extremely complicated. And because you have to look into the jurisdiction in each and every jurisdiction and what the effective tax rate is in each and every jurisdiction. So the rules are very complicated also in calculating these ETRs. So how do you go about achieving certainty and making the life of tax advisors of multinationals, as well as the life of tax administrations officials, very easy, if you have to go about applying the ETR? One idea that has been floated in the Pillar 1 document is to apply an ETR based on the CBC report as a safe harbor. Because when a multinational has to file its CBC report, it has to disclose the taxes paid in a jurisdiction and the profit that has been reported in the jurisdiction. And here the idea is that if the ETR based on the CBC report is higher than the minimum rate, for example, if the normal minimum rate is 12.5%, for the CBC minimum rate, they will probably say it's 15%. So if the CBC report indicates that you're paying 15%, your effective tax rate is 15%, then you would be exempt from doing some like these complex calculations for that particular jurisdiction. Another area where they are considering some kind of simplicity is just to exclude low profit entities from the calculation or exempt low profit entities from exempt multinationals from calculating the ETRs of low profit entities. So a low profit entity would be an entity which has less than 100,000 euros of profit, or its local profit is less than 2.5% of the global profit. So if you have an entity, for example, of a German parent has an entity in Switzerland, and the Swiss entity is reporting profit which is less than 2.5% of the group profit or less than 100,000 euros, then you would exempt the German parent from doing these complex ETR calculations for the Swiss entity. Similarly, another simplification that is being considered is to ask the German, coming back to an example, German parent with a Swiss subsidiary. So here the German parent would have to do the calculation of the ETR of the Swiss company for the first year, for a base year. And if the ETR of the Swiss entity is higher than the minimum rate, let's say the minimum rate is 12.5, the rate agreed for this simplification purposes is 15%. If the ETR of the Swiss entity is more than 15%, then in that kind of situation, you would not really need to, in that kind of situation, that test is satisfied, then you would be exempted from doing that ETR calculation for the next 3 to 5 years. And a last simplification measure that is being considered is that you just make some ex ante presumptions that that a country is a very low risk country whose rate will never go below 12.5%, which is the minimum rate. For example, you have high tax countries like Australia, New Zealand, US, UK, China, India. So you just make some presumptions upfront saying that, okay, if you operate in these countries and you're not subject to any special regimes in these countries, presumption that the effective tax rate in that jurisdiction will always be higher than the minimum rate. So there are some simplifications that are being considered for calculating jurisdictional ETRs. So what we've also done here at the university is that we have, when the BEPS project was had started on Pillar 2, and in last year we had submitted our comments for the public consultation. We had identified these kind of issues in the document, saying that it's just at the compliance, from a compliance standpoint, it's very difficult for an M&E to make ETR calculations. So if you take an M&E like BMW, which has operations, a German company, which has operations all over the world, and they have to start calculating ETRs in each and every jurisdiction, it can lead to a compliance nightmare to do this for each and every jurisdiction. So what we had suggested is to follow a global blending approach, even though profit shifting and tax competition can still survive under a global blending approach. It's a trade-off. It's a trade-off between simplicity and a trade-off between simplicity and complexity. The trade-off could be you can still allow for some profit shifting and tax competition to still exist. So that was with respect to effective tax rates. Before I go into the subject to tax rule, Mr. Kapadia, do you have any questions on the calculation of effective tax rates as such?
Yeah, I was just wondering, see, we all have tax disputes. Year on year means the rate of tax may be 30%, but the tax base may be changed by the tax department at the time of completion of SSH. And therefore, the effective tax rate, as we understand, might change. And this may be a process which goes on first appeal, second appeal, and then the courts. So first is at what time do we determine the rate, and what is the whether we take into account the disallowances or the disputes to calculate the ETR. That is one question which was in my mind.
Yes, actually, they have identified the specific example on this point in this report. And in this kind of situation, they say that this, let's say in year one, the Indian company which you're advising is paying a tax of the actual, when it files a tax return, it pays a tax of $100. And there's an assessment that has been done by the tax TPO, ATO, everyone, the tax assessing officer, and the case goes to court. And in year 5, the court comes out with a judgment saying the tax that has to be paid by this company is $150. So so the $150. So when it filed its tax return, it paid $100 in year 1. And then in year 5, the court judgment comes out and it says, okay, it's $150. So this $50 that is being contemplated, which is the tax, it will actually be an excess tax. It will go into the calculation of excess taxes. And from year 5 onwards, prospectively and not retrospectively, it will be taken into consideration for the ETR calculations. Hope that answers your question.
So it will not be going to the year 1 to which it really pertains.
Yeah, it will not.
So year 5 might be a loss year, and it may not make any difference in that year. So that will be just bad luck.
Yeah, it's taken into account for future calculations, not for you cannot open your income inclusion rule retrospectively and ask for refunds under the income inclusion rule. So For future years, it will be taken into consideration.
Okay, thanks.
Okay. Any other question? If the participants have any other questions on ETRs as such?
Not on the ETR, there is another question which is interesting, which was we had that even yesterday, that these rules seem to be applied not to just the digital economy, but even the brick and mortar economy.
Yeah, this
So,
applies to everyone.
yeah, so means one was to look at the background of the BAPS project and the uh, way the pillars have been introduced. It seems that this was basically for the digital economy, but now it is actually trespassing everything and going to rewrite the rules of the entire game. Am I right?
Yes, actually, what has happened with the digital economy debate is that there was, the initial issue that was identified was allocation of taxing rights, and that is being dealt with Pillar 1. But what's happening is with the digital economy is, there is this mobility of functions, assets, functions and assets. So in the digital economy, it's very easy for you to move around your people from one location to another location and do business remotely, as well as, you can book intangible related profits in low tax countries. But I do agree with you. So the BEPS Action 1 issue was more towards allocation of taxing rights. This has come through the back door, the Pillar 2 proposal. And there are some reasons for that is because people didn't really realize, but the BEPS action plan, because what they were doing is they were trying to align taxation with value creation. In other words, taxation where economic substances, where people activities are. They started, there was this huge surge in tax competition and profit shifting by multinationals. So before it was fake profit shifting, and now it was genuine profit shifting. And then countries also started dropping their corporate tax rates and started introducing tax incentives. So this was an issue which was not really actually in the BEPS Action 5 report, if I remember correctly, there was a phrase which said BEPS is not about tax rates. BEPS was never about tax rates as such. But now the debate of the digital economy has moved beyond, it is all about tax rates. Pillar 2 is all about tax rates. So there is some kind of ambiguity between what was said in BEPS Action 5 and what is actually happening now. But there are some logical reasons for why it is happening, because like I mentioned to you, this rampant profit shifting and tax competition among countries. So they want to put a break to that.
Okay, you would like to supplement?
No, so I just had one question, and maybe it is theoretical, Nilesh, to follow up to your question, which is, allocation of profits to low tax countries. It's one thing to say that this is in the context of digital economy, but Vikram, here is a very practical situation in India. We have a substantial reduction in corporate tax rates, but I must say that hurriedly that this is only for manufacturing. Secondly, the government offers a profit-linked incentive to certain specified industry like mobile manufacturing, special electronic components, active pharmaceutical ingredients. From a globe perspective, will these forms of reduction in corporate tax rates, which are targeted, and certain forms of production-linked incentives, which are also targeted, be covered?
Unfortunately, yes.
Okay. Thankfully, these are all for manufacturing, so we don't need to worry about it.
No, actually what I meant, they will form a part of the income inclusion rule. So, so if you have a German company which has an Indian subsidiary, which is actually taking advantage of all these rules, and let's say because of taking advantage of the rules which you mentioned, Mr. Bhutani, the corporate tax rate for this Indian subsidiary in India is effective tax rate is 5% as a result of these rules, or even 0%, then actually there would be an income inclusion pickup at the German level.
The reason, Vikram, this question assumes significance is that early this year, the WTO passed an order declaring all forms of incentives that are offered historically under the electronic hardware technology parks, software technology parks, special economic zones, and these are incentives which WTO has declared that these goes against the WTO commitments. Of course, India has appealed to the WTO tribunal against these decisions, but this is a big debate in India as well. So there is already an international body examining some of the schemes of the formulated, and these are not tax schemes. These are schemes that are formulated as a part of the foreign trade policy, but nevertheless, they are up for review before the WTO.
Yeah, so this is one of the big issues with respect to the GLOBE proposal, because the GLOBE proposals, the income inclusion rule doesn't really care if you have a tax incentive or not, they would apply to you. So that was one of the biggest issues which developing countries were also arguing for against the income inclusion rule, is because developing countries usually use tax incentives to attract people and capital, especially capital, for creating local jobs and all. And you know, if you have a tax incentive, an entity sitting in a special economic zone, for example, of a German parent, then that entity will unfortunately be subject to the income inclusion rule at the German level. So this can have some kind of dissuading effect of moving manufacturing to developing countries. It could possibly be. So there's no economic study done so far. But this can be a possible outcome, a spillover effect of the GLOBE rules, where you know there could be two spillover effects, which I think which we can speak about is you know, manufacturing or jobs are not being moved to low developing countries. And actually, sometimes when I think about it, I think the big gainers of this entire GLOBE proposal are the small and medium-sized countries like Netherlands or Luxembourg. Why? Because if you see the low tax countries as such, the Cayman, Bahamas, BVI, all these countries are somehow going to, you know, multinationals will move their operations from these countries to other countries, and natural they would be offshoring from these small countries to small medium-sized countries, and there could be a lot of onshoring, for example, in Netherlands or in Singapore or in other countries which are above the minimum rate of 12.5%, or even Ireland or as such. So there could be, these rules could benefit these kind of countries.
Well, it's interesting and it's very timely as well, because this is part of some of these production linked incentives are being broad based now as a part of the Resilient India movement. And though this started in 2018, 2019, it was broadened in the COVID period. So I'm sure that the policymakers have some work to do in terms of some of these incentives falling on the wrong side of the Pillar 2 GLOBE proposals, because the whole idea is, rather than importing into the country, the foreign investment should come in by way of setting up manufacturing units in India. And it is those manufacturing units which are entitled to the low tax rates and the production linked incentives, of course, in a very, very targeted manner. Thank you, Vikram.
Yeah. Yeah. And actually, I think the way the rules will be implemented and in the future is that these are not going to be minimum standard rules. So these rules are going to be proposed as best practices. So I don't think not all countries are going to adopt these rules. So it's going to be, it'll be interesting to see what happens in the EU, whether these rules are going to be made mandatory or not. But at this stage, we have no clarity what happens in the EU. But definitely, I'm sure a country like Germany will introduce the income inclusion rule, because they have been advocating for this rule for a very long time. Okay, so
But like the example of UK and USA, which you said gave about the conflict of countrywide or global comparison, then unless there is unanimity, will it be practical to implement this?
that's what they've been saying, to grandfather the guilty rule. Do that. So, But the US is okay with the rules. The US is okay with the income inclusion rule because they have it themselves, which is called the GILTI rules. But the operation of GILTI is a bit different from the operation of the income inclusion rule. So that's why the entire debate is these rules have to be grandfathered, the US GILTI rules. So some solution has to be found in that area. I don't know what the solution is going to be, but some solution has to be found there.
Yesterday, you gave a hint that maybe by 23 or something, Pillar 1 could come into force. Do you think Pillar 2 will come out simultaneously, or it will be even later?
So a lot of countries want this plans, both pillars to come out together. So it's a global package. So it's both Pillar 1 and Pillar 2. Some countries are okay with implementing Pillar 2 first and Pillar 1 later, and some countries want Pillar 1 first and Pillar 2 later. So the OECD is dealing with 140 countries, and it's not really easy, I guess, for them to accommodate the interest of all the countries, especially on these Pillar 2 rules. So, in my personal opinion, both Pillar 1 and Pillar 2, it will come out probably in 24 or 25, not before that. The actual implementation of these rules, the way it will be implemented in national law for a lot of countries.
Vikram, there is one.
Yeah.
Vikram, there is one more question that has come from one of the participants. It says the Pillar 2 proposals more seem to be aligned to domestic regulations of OECD countries, like you've been mentioning example of Germany and US, which is very different than the income allocation rules under Pillar 1. So will there be guidance that would be specifically directed towards the non-OECD countries should Pillar 2 become a reality?
Yes, actually, if Pillar 2 becomes a reality for the income inclusion rule as such, if it applies, no, actually, you know what? Can we just park this question if you don't mind? Because what's in the interest of developing countries is the subject to tax rule, which I'm about to speak about right now. So, if you just let me continue with my presentation,
Please go
because it's
ahead. Please go
important
ahead.
to speak about this rule. So like I mentioned to you, in terms of rule order, there was another rule that was being introduced, is the subject to tax rule. And very importantly, this is not a rule which allocates taxing rights. It is a rule which allows which basically allows countries to uh, um, to um, uh, impose certain withholding taxes on payments. Could you just give me a second, please? Because there's a little bit of disturbance here at my end. Just give me a 1 second, please. Hello? Yeah. So, this is a rule which does not allocate taxing rights among countries, but it is a rule which would apply, and it would allow the state of source to apply a withholding tax in situations where a payment has been made to a low tax country. So this subject to tax rule, why is it in the interest of developing countries? Because developing countries usually withhold taxes at source. And in fact, when I read a lot about this rule, I think the UN should focus on this rule as opposed to Article 12B of the digital project, because Article 12B is a non-flyer for developed countries. So the UN should actually focus on this rule, and they should really go about trying to advocate some kind of mechanisms which are mostly in the interest of developing country for this rule, because the subject to tax rule would apply to connected persons. So any payments that are being made between multinational enterprise. So imagine when a payment is being made out of India to like a um, let's say in Germany you have the parent BMW, in India you have a subsidiary BMW which is making cars. So if BMW in India is making a payment to BMW in Germany, this rule would apply. A royalty or interest payment to Germany the rule would apply because it's among connected persons. And like I mentioned to you, all base eroding payments are covered under this rule. And there could be some exclusions for this rule. For example, if there are low risk payments. So what do they mean by low risk payments? Is low risk payments are when you're paying like cost plus 5 return, or you're paying um, a return, cost plus return for some activity. So like, for example, if Infosys in India has a subsidiary in Poland to which it makes a payment, the Polish entity is a service provider. It's doing contract IT services for the Indian parent, and the Indian parent makes a cost plus payment to the Polish company for the IT services it renders. Because this is low risk payments, cost plus payments are low risk payments, they would be excluded. Similarly, the other way around, when you have a foreign company which is providing low value added services to an Indian company, and from India, there's a cost plus payment of 5% that is being paid out. So these kind of low risk payments are considered to be excluded, but all the other kind of payments like interest, royalties, franchise fees, brokerage fees, rent for assets, for immovable property, all these are covered under the scope of this rule. So all the high risk payments are covered. Some entities are excluded. So these are the same entities which are to which the income inclusion rule will not apply. So for example, when an Indian company is making payments to a pension fund or an investment fund, they would be outside the scope of these rules. There are some thresholds that are being considered. So when the Indian comes from India's perspective, when a payment is being made from, let's say, BMW in India to BMW in Germany, and if this payment crosses a revenue threshold, or let's say the value threshold, not a revenue threshold, crosses the value threshold of, let's say, 750,000 euros. This is just an indication that I'm giving to you. But if developing countries want, they can really go forward and argue that this threshold should be lower. And this threshold could be like, for example, even 200,000, 1 crore rupees. If a payment of more than 1 crore is being made from India to a low tax jurisdiction. So actually, I'm sorry, I gave you the example of German parent, but that's not a very good example. So if I just change the example, if I just say if an Indian entity is making a payment to a country such where the effective or the nominal rate is less than 0.5%, then India can withhold taxes. And there are some kind of thresholds that are being contemplated on how this payments rule would actually work. The question here is, how do you determine, the big question here is, how do you determine nominal rates? It's very simple. You look into the CIT rate, you see the standard CIT rates, and you also see the tax incentives offered in that jurisdiction. And if the tax incentives indicate that, or special rules or tax incentives indicate that the nominal rate there is less than 7.5%, then a top-up amount can be imposed by the paying jurisdiction, as I've explained before to you, under the subject to tax rule. A lot of work, the OECD will, I'm pretty sure, will do a lot of work. They've also indicated is they will come up with a database. In the pillar 1 report, they said they will come up with a database, and in this database they will write what are the corporate nominal, what is the statutory corporate income tax rate, and what are the nominal rates for certain payments which are being made into the jurisdiction. So some kind of additional work, a lot of additional work will be done in this area to determine the nominal rates, because the OECD plans to set up a database which will map what are the nominal rates or adjusted nominal rates in every jurisdiction, because the nominal rate is the statutory income tax rate, but the adjusted nominal rate is the rate which takes into consideration some special incentives or rules which are applicable in a jurisdiction. This nominal rate is pegged to be lower than the income inclusion rate. Why? Because it applies on a payment basis, and there could be several payments. It does not apply at one time at the level of the parent. At the end of the year, it applies on a payment basis. So because there can be so many payments that are being made, and because this rule applies on a gross basis, the logic used here is that because it applies on a gross basis, whereas the income inclusion rule somehow applies on a net basis. There is a lower rate that has been designed under the subject to tax rule of 7.5%. There are a lot of issues with this rule, and this is where the public consultation is very important. And I hope a lot of developing countries are participating for appropriate formation of these rules, because this is really in the interest of developing countries. Because I'm pretty sure the OECD would have known that if they want some kind of agreement on Pillar 2, they have to hear the developing countries' voice. And that's why, in terms of rule order, very interestingly, the subject to tax rule would apply first, then you have the income inclusion rule, then you have the under tax payment rule if the income inclusion rule does not apply. So here the priority is really given to the payment jurisdiction. In terms of compatibility issues, these GLOBE rules raise a lot of compatibility, could raise, in academic literature, it has been argued that the income inclusion rule, which is some kind of CFC rule, conflicts with the provisions of tax. But before we go into the income inclusion rule, you should know that there's been a lot of case law which has essentially already held in many jurisdictions. Majority of the case law says that CFC rules are compatible with tax treaties. Within the EU, you can apply CFC rules only to wholly artificial arrangements, so to generally fake companies. Then the question is, Pillar 2 didn't really address the compatibility of CFC rules with EU law, but it did address the compatibility of CFC rules with of the income inclusion rule with tax treaties, and they've come out with the conclusion that because CFC rules do not conflict with tax treaties, it can, on the same lines, it can be argued that the income inclusion rule, which is a sort of CFC rule, like a super CFC rule, would not conflict with the provisions of tax treaties. At the same time, there would be there are some issues with the undertax payment rule, because the way the undertax payment rule would work is not entirely clear. Whether it would be like an income, like a reverse CFC, reverse income inclusion rule, in the sense that whatever is not taxed by the parent under the income inclusion rule would be reallocated back to the UTPR taxpayer, or whether there would be a denial of deduction at the level of the UTPR taxpayer. Uh, uh, so the question is, if there's a denial of deduction, there has been some case laws which have held that thin cap rules would conflict with tax treaties. Within the EU also, there have been some rules which have said thin cap rules can conflict with EU law. Pillar 2 somehow says arguably UTPR is compatible with the non-discrimination provisions. There are no issues with the non-discrimination provisions as such, but this is a bit debatable. Compared to the CFC side, I think on the thin cap rules or on the undertax payment rule, because it's based on a denial of deduction logic or a reverse CFC rule logic, there are some arguments which can be raised to say that these rules actually conflict with the provisions of tax treaties. In terms of implementation, so message here is it's not 100% crystal clear. I'm not convinced with the arguments put forward in the reports that the UTPR is compatible with non-discrimination provisions. With respect to implementation, very quickly, the implementation of these rules would require changes to domestic law. When I say which rules, let me be more precise. So the income inclusion rule and the undertax payment rule will have to be implemented by changes to national tax law. Countries will need to, but on the other hand, countries will need to agree on a rule order. And these countries, when they have to agree on a rule order, that will have to be done through a new multilateral convention. And I'm pretty sure disputes could arise between countries and taxpayers and countries with respect to the income inclusion rule and the UTPR rule. And if disputes arise, then some new kind of dispute prevention and resolution tools, which are somehow similar to Pillar 1, are being considered in this new multilateral convention. So to summarize, IIR and UTPR would require domestic law changes. So there will be a model legislation that will be provided by the OECD. At the same time, there would be a multilateral convention to which all countries have to sign up, countries which are introducing IR and UTPR, to agree on the rule order, as well as some dispute prevention and resolution rules. On the other hand, some changes will be required to be made to the double tax agreements which countries have with one another, because the STTR, the subject to tax rule, and the switchover rule will require changes to double tax treaties. So you will have to, these rules can be implemented only if there are some changes to tax treaties. And these rules will have to be implemented, can be implemented through bilateral negotiations. That would be one way to do it. Or you can go through the existing multilateral instrument, and countries whoever want to introduce the switchover rule or the STTR rule go through the multilateral instrument, and they agree on the STTR and the switchover rule. So for developing countries, I think the STTR is really a rule to look forward to. A lot of work has to be done on this rule still, and I really think it can be in the interest of developing countries, with respect to this rule as such, because it's applying on a payment logic. So just to conclude my presentation, I would just like to say that pillar 2, I think it would be like best practice recommendation as opposed to a minimum standard. Pillar 1, on the other hand, would be a minimum standard. I'm pretty sure about that. Pillar 1 has to be a minimum standard. And in the Pillar 1 agreement, I think countries will also have to agree with the fact that if we go ahead with Pillar 1, we will switch unilateral taxes. The biggest issue in the Pillar 2 proposal is to calculate jurisdictional ETRs. So simplification is a must. And the 4 options that have been given, that I've put forward, or which have been considered in the OECD's Pillar 2 project, should be taken seriously, because if you ask a multinational enterprise to do these jurisdictional calculations every year for each and every country, it's going to go crazy. And then even the tax administrations, when they have to audit jurisdictional by jurisdictional whether ETR computations, they are also going to go crazy. So simplification is a must in this area, and this is one area to look forward to. India, as well as other countries, should, without a doubt, I think, introduce STTR as its payment-based rule. Now, India should, in my personal opinion, what I'm saying is my personal opinion, I think India should adopt the STTR in its tax treaties. In all its tax treaties, it needs to adopt an STTR coupled with Pillar A, Amount A. I'm not really convinced with the UN proposal, so I would still suggest policymakers to actively participate in the Pillar 1, possibly argue for higher reallocation to developing countries, including India. 2 forthcoming events I just want to mention to you, because I received a lot of LinkedIn messages yesterday. We have a transfer pricing and a profit allocation conference that is coming up in June, in January 2022. I've already put the link to the conference in the chat box, so you can access it from there. Registrations are open. They will be closed by probably the end of this year. So you still have time to register for that event. It's a free event, and we have a fantastic speaker lineup. Even Mr. Bhutani is speaking in that conference, among other very good speakers. So sign up for that conference, and we would really look forward to welcoming you online in Lausanne. And we still have our executive program in transfer pricing. Some seats are still available, open in this program. So if you really want to understand business models, transfer pricing, and profit allocation in a digital context, we have a fantastic program with top speakers. You can have a look at the faculty, the brochure, and you can decide whether you want to do it or not. And the link to the program is here. So with this, Mr. Bhutani and Mr. Kapadia, I'm done with my presentation. So if anyone has any questions, I'm happy to take them.
Go ahead, Nilesh.
No, I think there are no questions, and you have covered it quite comprehensively. So I can only thank Vikram for a very extensive, comprehensive coverage, and request Mukesh to join me in thanking Vikram.
Yes, thank you very much, Vikram. We enjoyed it. As I'd mentioned, that Pillar 2 is still something that we are observing because the discussions have been focused on Pillar 1. But this was an extremely enlightening session. Thank you very much. And with that, friends, we come to an end of our three-part series. We trust you enjoyed it. All the participants who are registered will get a copy of the recording and the presentations as well. And if you'd like to share any feedback, please feel free to do that. Thank you.
Thank you.